How's it going, fellow traders? It's Magic Trader here, and this is the CFTC report for July 11, 2017. Some interesting things I came across this weekend when I was doing this report. I'm always learning. Every time I do a report, I always learn something new. It could be very small, it could just be a little nuance that I add to my ability to interpret the data. But this past weekend, I figured out something pretty interesting, something that I think is going to put a little bit more of an edge in my trading. And so what that something is, it's not anything new particularly, because I've noticed this little thing quite often in my analysis of the COT reports. But the way I am going to be using this information is going to be new. So if you take a look at the report, I'll give you an example of how I use this information. And I think I used it on the euro. Okay, right here. So we have a situation where the euro is breaking up to new highs. Sorry, not new highs, but new recent highs. So breaking up higher, higher, higher. So then the question comes into what zone is going to be the zone that price is going to drop down and react from. So what I've noticed a lot in reviewing the data from the institutions and reviewing charts is that sometimes price rallies not only because of demand being filled in by the institutions, but sometimes price rallies because of institutions closing off a bunch of selling positions. Alright, I have seen that numerous times where price will rally up and it's not so much that they were adding buys or long positions. Sometimes it's because they were closing off a bunch of selling positions. And so if there was a lot of demand coming into the market, obviously they need demand to come into the market for them to close off their selling positions. So if there's more demand than there is supply, price will go up. So that area where price rallies up from, it obviously, if it's because the institutions are closing shorts, this is not an area that we would like to go long at. Now, if you don't study the COT reports or know what the positions of the institutions are, then you wouldn't know that that area where price rallied from is demand or supply being closed out. You wouldn't know that. So, over the years of me analyzing the charts and analyzing the COT data, I've come to realize, hey, price moves in very different directions, upwards at a 90-degree angle, upwards at a 45-degree angle, upwards at a 15-degree angle, in all sorts of directions. It moves upwards and downwards, and it's all based on how the institutions are positioning themselves. So as I've come to learn how price moves based on the positioning of the institutions, I've also come to learn about the importance of whether a zone is created by institutional demand or supply, or is it being created because of the closure of positions. So really important thing to recognize. So when looking at this euro chart, I'm trying to decipher where's the best place to get in long, because obviously the institutions want price to go higher because that's what's happening, and there's nothing to stop price from going even higher. So where is the spot that I'd like to get in long? So this weekend I was analyzing this area here, this area of demand here. We had this big explosion to the upside. And so I was looking at the dates of when this happened. So let's just go there right now because I want to show you something. The euro right here. Okay. So let's go to a daily chart. Alright, so here's a daily chart. And here's the explosive move right here. This happened on the 27th of June. All right. So on the 27th of June, something big happened. So now I go over to my chart, all my recorded data from all the previous weeks of the CFTC report, and I check out that date. Was it again the 26th of June? Was it 27th of June? So I go and I check it out, and what do I see on the 27th of June? Boom. Large increase in demand. All right, so take a look. May 30th was some big numbers, but then June, early June, they took off those right here. They took off those longs. And so then the next time the institutions filled in some demand was here. From 167,000 to 179,000 positions. Okay, so that's what? 12,000 positions? 12,000 positions were added right here. This is where the beginning of the 12,000 positions were added. So this rally up was 12,000 positions. So now I can be assured that next time price gets back down here, that this is an area where the institutions filled in 12,000 of their positions, 12,000 longs. Okay, and then we can take this even one step further, and we can analyze the charts to see what is the average position that the institutions would have been holding long on this currency pair when they were under the impression or under the belief that price was going to go higher and they wanted to take it higher. So we can go and open up the data and take a look back and see. So 179,000. What has the positions been in the past? Well, let's look back. As far as my data goes back, January 6th on this chart, I don't have anything higher. Okay, but as time passes and years pass, I'll be able to have a collection of data that spans years. And I'll be able to look at the chart and I'll be able to see when's the last time the institutions were really pushing for the euro to go higher, which is the same scenario that we're in right now. And I'll look at what size positions they held. Now let's say they held positions of 240,000 long. So I would make the assumption that they would probably want to have roughly the same amount of positions long, since the situation is similar to those in the past. So let's say 250,000. And let's say right now they're at 179,000. So I would know the difference between 179,000 and 250 is pretty much a large gap. All right, you got about 70,000 contracts that they still want to fill in. So with 70,000 contracts wanting to continue to be filled, then it's safe to say if this area was an area that they filled in 12,000 contracts, then it's very safe to say when price gets back down there, they're going to want to fill in another 12 or another 15 or another 20,000 or whatever the case may be to get price to continue moving to the upside. So this just basically assures me, doing this type of analysis, that indeed price is going to retrace eventually, and when it does, where are the key points where the institutions were adding those long positions? All right, so you can see how powerful this stuff can be, right? It can be extremely powerful. So with that being said, I don't want to take up too much more time because we're already about 9 minutes into the video. But I do want to make mention that on Wednesday we have the Bank of Japan interest rate being released, and on Thursday we have the euro releasing their rate. So it's going to be some interesting moments this week. So let's get down to the nitty-gritty and let's take a look at gold and see what the institutions have been doing. Okay, so gold, what have they been doing? They're getting aggressive with their shorts, right? And that happens with this candle right over here, this big drop. So that makes sense that they were aggressive with their shorts, because how else are you going to get price to drop down? they have to get aggressive. So they got aggressive with their shorts and price dropped. Bearish bias right here, and net positions drops. It used to be 190, 204, look at this, 204, 190, 150, 130, 93, and 60. So their bullishness is just dying and dying and dying. Well, we knew it was going to drop, right? Because price was hitting a monthly supply area, so we knew we were going to be getting a drop. But let's not forget that a 3-month demand zone is in control. So over the long term, this is what we're expecting, right? So right now we're testing a weekly demand area, and we're very bearish. Well, we're very bearish because price had to drop from monthly supply. Supply was filled in, and that's why we see this increase in supply here. So what's happening with long positions? So when supply was filled, they closed off their longs, which would make sense. Some profit taking, 297, 252, 236, 221, 217. So slowly declining, but now we've reached this area of tested weekly demand. Now price can just test this area here and drop back down. That's possible. But how are we going to determine what's going to happen here? Well, it's very difficult to determine what's going to happen here. I think a large aspect of what's going to happen here is based on what's happening with the US dollar. And we'll take a look at the US dollar soon. The price is dropping on the US dollar, and if price continues to drop, then this may just continue to go straight up. So what am I planning on doing? Well, I'll tell you one thing. I won't take any longs until this area is broken. Once this area is broken, then I'll consider taking longs. So I'll consider taking longs if that area breaks, or I'll take longs down here. Alright? But when this area breaks, I want to see that they're adding longs, and aggressively, planning to take this to the upside. I want to see that. And if I don't see that and this breaks up, then I'm going to hold off and wait for these areas here to be broken. But I do want to see that strong strong demand coming into the markets through the institutions, and I want to see them close off those shorts before I decide to go long. So that's what I see here on gold. Let's go to the next one, oil. Institutions closed out some of their longs. That happened as price dropped here. And shorts also closed off from 292 to 270. So in the process of all these closures, shorts and longs, we have an increase in long exposure by 2 points. Now they're 70% of the portfolio is geared to the long side, and net positions increase. So overall, their exposure to the long side has increased. All right, from 341,000 positive positions to 358,000 positive positions. Now, I was looking at an area to take a long down here, but I wasn't quite convinced. I said I wanted to see price come up a little bit more. I want to see what it's going to do at this weekly trend line, and if it starts to break to the upside and I see longs being added to and shorts being closed off, then I'm going to look to take positions to the upside here. Okay, I think that's probably what's going to happen, but not for sure. Right now, the indication is neutral. Right, the cells are blue, even though it's 70%. It's still blue because look at what they used to be. Right, when they used to be like this, and price was very bullish. That's what I want. I want them to be back up there. Until they're back up there, then I know they're not 100% committed to the long side. So I want to see the green pop back in, and then I know that they're committed. Alright, so let's go to the next one, US dollar. Here we go. So the US dollar, I did some more analysis on the US dollar this past weekend, and as many of you know, I've made some alterations to the rules that I originally began trading with to reflect some observations that I've made in the markets over the last 4 years. Particularly in the last 2 years. So I've been putting a lot of time and effort into studying charts, day in and day out, and doing my best to understand why price does what it does and why it doesn't do what I thought it was going to do. And I've come to learn a lot of things. So I've changed the rules to reflect my observations. And one thing that I've been trying to do is, once I make these observations. I study the charts based on my new observations, and over the last 6 months to 8 months, I've learned that my observations are correct a lot more times than not. And so I've changed my my trading rules to reflect them. And so I've done my best to go through all my charts and to change the analysis that I've done on some of the higher time frames. And unfortunately, the US dollar was one of those charts that I missed something. And what I missed was basically this area that was previously drawn out to be demand. Well, I've reanalyzed the charts and I've come to learn that this area is in fact not demand. So, with no demand being here to hold price, it's very easy for price to continue dropping. So, if price continues to drop from where it is right now, then great. Gold is probably going to shoot up to the upside from where it is. But we have a slightly tested area of weekly demand here, so price can go like this, then rally up, maybe to even this area here, and then drop further. That's a very big possibility. So I'm waiting to see when the US dollar breaks to this area, because we've already dropped quite significantly. So, you know, are we going to get a move to the upside, a slight move before continuation, or are we going to consolidate here before a move to the downside? I want to see what the US dollar is going to do. Once I know exactly what the US dollar is going to do and I see exactly what's playing out, then I'm more inclined to take a position not only on the US dollar, but also in gold. Alright? But I believe what's going to happen is this area is going to get broken, a retrace, which will be a new zone here, and then a move downwards. That's what I think is going to happen. So, you can see that they're definitely short biased right now. Very strong coloration of the sells. Even though 52% of their positions are geared to the long side, considering what we used to be at, this is considered very bearish. And you can see it is very bearish. Nothing to stop price. This is very bearish. Okay, so let's go to the Aussie. What happened with the Aussie? Aussie hit that area of demand that we had drawn out for quite some time. I mentioned in previous analysis that this area of demand was a very, very strong area of demand because it broke a very important trend line. A trend line that was respected and goes back a long, long time. So let's take a look at that once again. So we had a trend line here going back a long time. Boom, it was hit here, dropped down, resistance, 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 boom! Institutions come in, they recognize that there's a trend line there, and they have to fill in enough demand because they have made a decision that price is going to go up. So when they make that strong decision that price is going to go up, and they recognize that there's a trend line there and price keeps butting up against it, they know that everybody is looking at that trend line, and everybody is assuming that price is going to drop when it hits that trend line. So for them to be able to change the momentum of this market, they need to come in with some serious demand so they can get things moving. And so boom, right here, they come in with some serious demand. They retrace because they don't want price to go up too high, and then they get in once again, fill in the rest of their orders for price to go up. I'd actually like to go back now and on my own time, obviously, because then this video will go on for too long, and take a look at what demand was being filled in here and what it looks like on the on this chart here. Let's do it together. What the heck? Let's do it together so we can both learn. It started here. Let's see, is that January 1st? January 1st. Alright, let's see, January 1st. Boom, 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 boom. No, I don't see any demand there. There's a weekly chart. So, January 1st. January 8th. So the month of January, the beginning month of January. No. In February we start seeing their positions. But what do we see here in January? 47.51, 40, 54. So we see shorts being closed off. 51, 44, 37. And then longs not really doing anything. But once they close off those shorts down to 44, 47, they start increasing shorts, and then aggressively in February adding longs. So aggressively in February would be right here. Aggressively starting adding longs. So yeah, January, aggressively adding longs there and then back. So in this case, the data wouldn't have helped us, just the technicals, because in January all we saw is shorts were closing out and they only started becoming aggressive with their but then again, this is based on data that only goes back to January, so maybe it wasn't as accurate as it could be if I had more data. So anyways, as time passes, I'm going to continue to check this out and look into this information and see if I can see any telltale signs before things happen. Okay? Alright, let's get back. Let's get back to the US CAD. What do we see with the US CAD? Longs closing out, becoming very cooled off. Yeah, I'd bet. After a drop like this, you know, from monthly supply. Big drop downwards. Shorts getting aggressive. Down here at this candle. Shorts getting aggressive. Longs being closed out. Neutral territory. Don't do anything. Yeah, because I wouldn't. After a huge drop like this, and we're hitting tested area of weekly supply. So just like the US dollar is coming towards tested weekly supply, the US CAD is coming towards tested weekly supply. So this can continue dropping further. This area can drop and price can go even further down, test deeper within this area of demand before we get a move to the upside. But I do believe we're going to get a move to the upside from this area somewhere in this area, because it is a 3-month demand zone that we are reacting from. Okay, and let me take a look one more time. Okay. All right. Swiss franc. Not much happening. Longs are cooled off, so are shorts. Overall, somewhat bearish, but more neutral, so not doing anything. Waiting on what the US dollar is going to do before I make a move on this pair. The euro, we just went over the euro, and what we can basically see is they continue to add in their long positions, and they're closing off their short positions. So, closing off shorts, adding more longs, coloration here, very bullish, increasing their net positions to long, and demand. 12,000 positions were filled here. Most likely more demand is going to be filled when price gets down there for a move to the upside. So that's what I'll be watching on the euro. The pound. Longs are cooled off. They were a little bit aggressive. They became a little bit more cooled off. And shorts are cooled off right here. Overall, slightly bullish, but not by much. Looks like we're going to penetrate and break through. I believe that's what's going to happen. Weekly bullish engulfing candle here. If it breaks through this area, we'll have an area of demand, just like on the euro and just like on the US dollar. I think this area is going to be good for longs. Even though monthly supply will still be in control, it's poorly formed. Only one candle downwards, so it's not very strong. So a retrace here up once this area is broken is what I'll be looking to get in long with. US dollar, Japanese yen. What do we see? Longs are becoming even more aggressive, and that happened with this candle as it rallied right into tested weekly supply. So very weak here, very weak. But there's a trend line here that might be important, might not be important, but it's an area that I'm watching. Because once price gets up here, I might see a reaction to the downside. Not sure. But this is not actually supply. It's just resistance. Been tested once. So it could easily break up like this. But I think the US dollar being very weak is actually holding this one down. So if price reacts to the upside from the US dollar off that weekly tested demand zone, we can see a penetration of this area, then maybe some new levels to take this to the upside. Not quite sure. I'm just watching this one for now. Last, Kiwi dollar. What do we see here? Longs remain aggressive. Shorts remain cooled off. Bottom line is they are bullish. Net positions have gone up just a little bit, but not significantly. But we have that 3-month area of supply just up ahead. So just like the US CAD, we have that area of 3-month demand just below price. On here we have that area of 3-month supply just above price. So I think we'll probably get a deeper penetration and then eventually a move to the downside. That's what I think. Not 100%. That's why I'm watching the data, and we'll see what happens. Not looking to take any positions on this one. Alright guys, so that's it. Long video, 26 minutes. I'll let you guys go. Hopefully this was informative for you guys, and have a good trading week out there. Bye.